Hello and welcome to the Business Standard Banking Show. The Reserve Bank of India increased the repo rate by 25 basis point to 6.5% during the February review of the monetary policy. Since May 2022, the repo rate has been increased by 250 basis points. How have these actions impacted banks' performance in terms of growth and margins? To discuss some of these issues, today we have with us Rajiv Anand, the Deputy Managing Director, Axis Bank. Mr. Anand, welcome to the show.
Thank you for having me, Manojit.
Are you saying an impact on loan demand, particularly on retail side, due to the sharp increase in interest rate over the last few months?
I think what we have seen so far, Manojit, is in a sense a normalization of interest rates. Interest rates were brought down sharply during the pandemic, and what we are now seeing is a normalization of those interest rates, and now increasingly, some tightening of that liquidity as well. Because if you look at rates relative to let us say 31st December 2018 to where we are today, some rates are slightly higher, some rates are the same, but one of the rates which are lower is corporate rates, and maybe we can talk about that a little later. So in that sense, we are not yet seeing any impact on growth. So much so that I think in an environment that the RBI predicts for next year, which is 6.4% growth on GDP,
Right.
with about 5.4% inflation. If those two metrics do play out, we do believe that credit growth for next year will also continue to be quite strong, somewhere in the 15% vicinity.
So yes, the credit growth has been strong so far. But on the retail side, have you seen some impact? I'm asking this because Axis Bank's home loan growth was in single digits for the first 9-month period. What could be the reason for that?
So I think there were some sort of tactical decisions that were taken by Axis, and you will see a more normalized growth rate on the retail side. We are not seeing any sort of material impact at this stage from a demand perspective from the retail side. Um, last year same time, the third and the fourth quarter were quite strong. So obviously the base effect is also playing some part. But I think it's fair to say that at this stage, the higher interest rates are not having any material impact on demand.
Coming to the corporate loan side now, corporate loan growth has been robust, not only for Axis Bank, for other banks also. But I wanted to know, is it mostly demand for working capital refinance, or are you seeing some private capex demand also?
I think it's a mix of all the three. We are seeing higher working capital demand. We are seeing some refinance activity. But I think more importantly, the last point that you made, I think the private capex environment is probably the best that we have seen in the last 3 years. Is it as much as we would like it to be? Probably not. But I think we can well and truly say that the new private capex cycle has well and truly begun. And barring any untoward incidents in 23-24, in an environment where the economy is expected to grow 6.5%, I think private capex should continue to be reasonably strong. In fact, will gather momentum in 23-24. In addition to that, we have also seen in the budget a significant increase in government capex as well.
Right.
I think if you put both together, it augurs very well, for India from a gross fixed asset formation perspective.
Can you tell us some of the sectors from which this private demand is coming from for capital expenditure?
So we are seeing a fair amount of activity in renewables.
Mhm.
We are seeing activity in city gas distribution. We are seeing activity in roads. And in fact, we are now beginning to see capacity expansions in iron and steel and even FMCG. There is a medium-sized coffee company who is looking to increase capacity. So the point I'm making is it is becoming more and more widespread as we speak.
And you expect the loan demand, corporate loan demand, to sustain in the next financial year also.
I'm very confident that that corporate credit demand will sustain as we go forward. I think if you look at it in the context of what happened over the last 3 to 4 years, when corporate India was actually in a deleveraging phase,
Right.
where they were raising equity and utilizing their own internal resources to pay down debt. I think that cycle is now pretty much done. We are in an environment where corporate balance sheets are in probably the best shape that we've seen in a decade, and on the back of that, we're also seeing that capacity utilizations are now in the 75 to 78% vicinity. I think
Right.
both these clearly indicate that corporate India is now once again back to increasing capacity, and so therefore to that extent, we will see a fair amount of strength on the private capex cycle. However, I must mention here that not all private capex expenditure may come to banks, because I think we are also seeing that corporate sector's cash creation uh, continues to be quite strong, and they are not averse to using their internal accruals first, before approaching banks, to lever up their balance sheets.
So that's an interesting thing you're saying. You're saying that before coming to banks, they may use up their own internal accruals to fund their expansion.
To some degree, we are already seeing that. I mean, we have
So,
already seen some steel and cement companies, use this methodology because of the fact that internal accruals have been very strong.
is it also because of the interest rate environment? The rate environment is going up, though there is expectation that RBI will pause now. But do you see how do you see the rising interest rate to on the demand side? The impact, its impact on the demand side.
I think one has to look at it in the context of our interest rates. I mean, ultimately, when the corporate is looking at at its capital structure, it has multiple ways to be able to finance that. It may raise equity, where one could argue that valuations are quite attractive for companies to raise equity. However, on the other side, there isn't that much of an arbitrage between raising bonds offshore versus raising money
Right.
from local bond markets or local banks. And so therefore those are choices that corporates will make from time to time. If they think that interest rates are very high, they may not raise money for the long term. They would raise money for a shorter period of time and refinance in the next 2 to 3 years. So there are multiple strategies that corporates would adopt to be able to optimize the cost of capital.
Now, coming to the liability side, some of the analysts have pointed out that the Axis Bank needs to beef up its retail term deposit mobilization after the Q3 results were out. What are your plans to beef up the retail term deposit growth?
I think if you look at our retail term, if you look at our deposit growth, we continue to grow, faster than the market. Um, and I think in an environment where we expect credit growth to be reasonably strong, even at an industry level, credit growth is faster than deposit growth. It's a similar situation, for us as well. And there are multiple levers that we have to be able to shore up our deposit growth. One is what we call sweat the franchise. How can we get more from existing branches, driving productivity, etc. How can we do more from our salary businesses? Almost 25 to 30% of new account opening is from new salary accounts. We have a very strong franchise within the government business, and more in the honorable finance minister has opened up more avenues to private sector banks. We are seeing that as an opportunity for us to shore up our deposits. And finally, of course, we are working towards becoming the transaction banker of choice for corporate India, and therefore we are expecting them to do more of their tax payments, more of their LCBGs, more of their trade finance through us, and that in turn will give us balances in our current account. So there are multiple levers for us to be able to drive deposit growth. But I think it's fair to say that that the growth of deposits in 23-24 is the one factor that is keeping bankers awake.
Coming to the retail deposit part now, do you see there is scope to interest rates to increase the retail deposit rates?
I think uh, you what we saw in this cycle was that non-retail term rates went up quite sharply uh, before retail deposit rates.
Correct.
But over the last 3 to 4 months, we have already seen retail deposits catch up with non-retail deposit rates. In fact, there are banks which are now offering 8% for senior citizens, which is a very attractive rate. How much more deposit rates will go, we'll have to sort of wait and watch. That will of course be based on the need and demand for money, which in turn is based on how credit will grow going forward. But ultimately, if deposit rates do go up, remember that through the MCLR mechanism, it will mean that rates for borrowers will also go up.
Correct. I'm coming to that because it is the net interest margin. Axis Bank has a fantastic interest margin in the Q3, 4.26%, which is an improvement of 73 basis point year on year and 30 basis point quarter on quarter. Given that 40% of your loans are linked to the repo rate, do you expect margin to improve further, or you think the deposit repricing will make it challenging to improve it further?
In fact, I would add, in addition to the 40% of repo, we also have other benchmarks, including MCLR,
Right.
which all put together approximately about 70% of the book is
Floating.
either external or MCLR benchmark or floating rate.
Yeah.
So therefore, to that extent, we will certainly benefit in a rising rate environment. Like you rightly said, the repo book will reprice on a T+1 basis, but assets which are linked to MCLR will reprice at the based on their time period, which is 1 month, 3 months, 6 months, or 1 year, as the case may be.
Now, coming to the Citibank transaction, initially it was expected that the deal will be completed by March 2023. It seems the deadline is getting pushed a bit. What could be the reason, and when do you expect the deal to be completed?
Manojit, I don't think your information is correct. We had said that we will close what we call LD1, the legal date one. That's the date on which we pay consideration. The assets and liabilities come to us. The people come to us, customers come to us,
Right.
and the employees come to us. We are well on track to be able to meet this deadline of completing LD1 in March of 2023. What will then happen is that there's a period of 18 months of transition.
Right.
When it will take us, as far as a Citibank customer is concerned, after LD1, he will continue to be on the Citibank technology platform, and he will migrate or transition to the Axis Bank platform over a period of 18 months, which is what we call LD2. So therefore,
Right.
there's an 18-month transition period. So we are well on track to meet our the
LD1.
dates, that LD1 date that we had broadly guided about.
When are you planning to raise equity capital, which is required to fund the City deal?
If you look at the consumption of CET1,
Mhm.
it is approximately about 180 basis points as a result of the consideration that is being paid. Even after that, our capital, CET1 capital, will be well above regulatory minimum. Regulatory minimum is 8%. We will probably be in the 13% handle. So we don't need to raise capital to fund the Citibank transaction. Do we need to raise capital? Remember that we are now in our, if you look at our P&L now, we are in a situation where our return on equity, the amount of capital that the amount of profits that the business is generating is sufficient to fund growth as we go forward. So therefore,
Right.
we are fortified as far as CET1 is concerned, even after paying for Citibank, and the profitability of the business is such that it is self-sustaining from a capital perspective. So at this stage, we don't see a requirement to raise capital.
Thank you. Mr. Anand, it was a pleasure talking to you as always. Thank you for speaking to Business Standard.
Thank you for having me again, Manojit. Thank you so much.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.